And that new information, Elliott charted, again, the price has dropped back, and it's what, $20-$30 below the Reserve Bank's forecast. So that's a significant reduction in inflationary pressure. We don't have a situation where interest rates are too low. We don't have a government spraying money around. So don't tell me there's a demand shock to the upside, because there's not.
We're just expecting people to want to return to some version of normal, and that is unlikely to have a huge demand pressure in the economy.
Which is outlandish.
But
on brand.
Yeah, on brand. Kia ora koutou, and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's Economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets, and analyse the issues impacting the Kiwi economy. Let's get into it. All right, kia ora koutou, and welcome to another week, another episode of Markets, Mystics and Mayhem. And you know what? We're a little bit more excited this week than we were last week. We've got some good news and we've got some additions to the team. So the good news is that the oil price remains low, and it looks like it's going to stay low, which really helps our call that this is a supply shock. Price goes up, price falls back down, we can look through it. And I guess we talk a bit about that in today's episode. So it's good news there. But good news for us is that we have employed another keen economist, Elliott Lowe. He comes to us from Deloitte. He's got some interesting experience there, and he's joining our team, and he's going to be based in windy, miserable Wellington. So we've got someone down there. But why don't we kick off? Elliott, why don't you introduce yourself? Tell us a little bit about you.
Well, thanks, Jarrod, and appreciate the little jab at Wellington there as well. So as Jarrod mentioned, my name's Elliott Lowe. I'm a new economist in the team, and really, really excited to be joining the Kiwibank team, working closely with Jarrod and Alexandra. So as mentioned, I have come over from Deloitte, spent a couple of years there as an economic consultant, where I worked on projects that involved forecasting, modeling, commentary, and the like. And really looking forward to kind of taking those learnings through into this role here. Prior to that as well, I had experience as a graduate teaching assistant in the economics department at the University of Auckland. And that really sparked my passion for communicating economic ideas to people, especially those who are not as well versed in economics, because I primarily taught relatively entry-level courses. And so really looking forward to continuing to be a communicator of economic ideas and sharing important insights of the world. But yeah, that's a bit about me. I am based in Wellington, born and bred in Auckland, to be fair, but made the choice to move down to Welly, where I actually quite like it in spite of the often miserable weather. But yeah, very excited to be part of the team. Thank you.
It's great to have you, Elliott. It really is. You're going to add a lot to the team, and we're quite excited to get you plugged in and hooked up and running.
Yeah, and we're so glad to have a third member back on the podcast, a third voice of reason, hopefully. New insights from you. Can't wait to hear what you've got to add.
Yeah.
But on that note, we have had some developments / not developments in the international situation with the war in Iran. What's been happening, Jarrod?
Is the strait open or not? I don't know.
No, so as
depends
it stands,
what day?
Yeah, it depends what hour actually. As it stood this morning, the strait was still closed.
Yeah.
It had opened for a short period when that peace deal was first signed, and I think that lasted less than a week. It was enough time for all of those tankers that were literally lined up at the doorway to the strait to get out. But yeah, the last 9 days it's been closed.
Yeah, and that's great, really, that you sort of got rid of some of that bottleneck. I saw some data that showed the number of shipments going through spiking to like 80 or 100 or something a day, nowhere near what the
levels were of about 150 plus.
We can probably
a day.
chart that for anyone watching.
Here you go.
Yeah, there we go.
But it's the impact that even that small opening has had on markets that I think we're most excited about, because the oil price is where.
Oh my God, back to normal.
Yeah.
It's been crazy. So
Like what war?
Exactly. The price of Brent crude, especially, I looked at it this morning, it was down in the low 70s.
Yeah.
Almost less than 70. I think it was 72, 71. That's obviously going to fluctuate. But Elliott had a look at the other oil price we track. Do you want to tell us a little bit about what you found?
Yeah, absolutely. So a really key oil price for New Zealand is the Dubai crude, very important to New Zealand's supply chains. And it's one that the Reserve Bank of New Zealand took a keen interest in when it was publishing its forecasts for the monetary policy statement back in May. And so if we track the historic price of the Dubai crude spot price, there was a pretty significant spike in March when there was pretty significant tension in the Middle East. The conflict was kind of at its peak. The price peaked at just shy of $170 a barrel, which is really significant. It then came back down. It was sort of hovering just over 100, sort of ranging between 100 to 105 US dollars per barrel. And that was about the time when the Reserve Bank was doing its forecasts for the monetary policy statement. And a really key factor back then is that the futures market, so essentially what traders think the price of oil will be into the future, was relatively high at that time. And so the Reserve Bank assumed that the oil price would come back to the normal range over quite a long period of time in quite a slow fashion. But the great news is that the oil price has actually come down a lot faster than what the Reserve Bank and indeed what the market was projecting back in May. So the spot price now, I believe the latest numbers show it's in the mid-60s, mid-$60 per barrel. And the futures market is also indicating that the price will be within that $60 to $70 range through to the end of the decade. Of course, markets are fickle. That could change, but right now we're feeling pretty optimistic that the oil price is in a better situation than back in May.
And I mean that really is good news. It is. I mean, we were thinking that this disruption, it wasn't going to the highly stressed levels that we thought. I mean, you say it went to 160 odd. It was only there for like 5 minutes. Yeah. In the scheme of things, the big risk was that it was going to spike and stay there. And like you say, the Reserve Bank has assumed a very gradual decline in the oil price. It's happened almost overnight, really. It's dropped back into the 60s. That's an incredible result, really. And what it means is that, well, we get the inflation spike in the second quarter. So the next CPI read that we get will be, what, 4 what are you calling? 4.2?
4.3, 4.2.
4.3, yeah. So it spikes above the Reserve Bank's target band. We don't like that. But as we've just talked about, it's temporary.
Yeah, exactly.
So what does that mean for inflation going forward? Well, a lot of it, hopefully, if prices stay at these levels, will be unwound in the third quarter.
Exactly. Yeah, because especially when we've talked a lot about how businesses facing the final consumer have felt a lot of pushback. Once the cost pressures are relieved on their end, they've got no reason to continue pushing for higher prices. They can go back to charging their normal rates.
That's a key point.
Exactly, yeah.
That's a key point. And I think it was interesting when we had that discussion with the construction company, how they were putting levies, or did they call them levies or something, surcharges on their contracts. So when the price of diesel went above a certain level, they started charging the surcharge, and then when it drops back below that level, the surcharge goes.
Exactly.
It's on and it's off, and we've moved on.
Exactly. And domestically, we've already seen the petrol price start to come down. I don't know if you've driven around over the weekend and saw any petrol stations advertising at least 91 fuel under $3 finally per litre.
Yeah.
And the longer that this price, the oil price is low, the lower that domestic petrol price is going to go. And that's going to be a huge relief for Kiwi businesses that obviously rely on diesel and petrol and other petrochemicals to do business in order to ship things from one end of the country to the other, in order to power their machinery. But it's always also going to be a huge relief for households, right? Because that increased price was on top of a cost of living crisis, and households were just having to wear it.
Yeah, exactly. Good news.
Very,
It's
very
just good news. That's it in a nutshell for me. And we've put out our Outlook note, came out earlier today, and I think we can sum it up as being this has been a hell of a shock, but we're fighting our way through it, and we're somewhat optimistic into next year.
Yeah, and to say we're optimistic doesn't mean that we are afraid of that inflation spike being sustained in the economy long term. Like, as you said, Jarrod, we're expecting that with the oil and the fuel prices coming down, prices that were mechanically brought up will come back down as well. So what does that mean for the RBNZ's call?
Let's ask Elliott. Let's put him on the spot.
Yeah,
See what he's learned.
Well, that's the question we're all wondering. And our view is that it means that it reinforces our view that holding rather than hiking at this upcoming OCR announcement is the right call. Because the medium-term risk to inflation now appears to be lower than previously thought by the Reserve Bank, oil prices have come down a lot faster than expected. Assuming that track continues, then there's less of a reason for them to want to hike rates to sort of manage inflation. Yes, there will be a spike in inflation in the second quarter of this year, as we've discussed, because oil prices were quite high during that time. But now that seems to have come back to a normal range, we really think that this means that the Reserve Bank should hold rates, give the economy a little bit more breathing room, so that it can really kickstart more of a recovery, and play it from there.
Because we've been saying all along, don't hike, let the economy recover. Don't hike, let the economy recover. And we were, somewhat shell shocked in May when the Reserve Bank came out as strongly as they did, and there were 3 votes to hike from the outside members. That sort of shocked us into thinking, well, they're going to hike in July, they're going to hike in September, and we'll be at 3% by the end of the year. That softened our, outlook, right? If you've got rates increasing like that, if the Reserve Bank does what you say, Elliott, and, hold like the right thing, what we've been saying all along, then I think we do get a better recovery into next year.
100%. And I think one of the things that shocked us the most wasn't just the fact that the Monetary Policy Committee was a split vote, 3-3, but it was the fact that their OCR track, they gave us 4 scenarios for an OCR track, and 3 out of 4 had them moving to 3% by the end of the year.
Yes.
And that was a really strong signal, and we're just hoping that they're willing to sort of reassess based on new information and not just hold on to an outdated view.
Yep. And that new information, Elliott charted, again, the price has dropped back, and it's $20, $30 below the Reserve Bank's forecast. So that's a significant reduction in inflationary pressure.
Yeah, and I think it pays to emphasize that this reduction in fuel costs domestically, we're not expecting this to really turbocharge demand.
No, it's not COVID.
No.
Yeah.
People aren't coming out of this crisis with huge buffers and a ton of excitement to get out there and buy lattes and upgrade their pools and
it's
buy
not
new
COVID.
furniture. No.
We came out of COVID like caged animals. We've said it before, we'll say it again. We were fired up and we were driven by massive government stimulus and record low interest rates, the lowest levels in the history of mankind, and we came out fired up. We're not fired up right now. Interest rates are not at levels that are stimulatory. You know, we say that the cash rate's at a stimulatory level, yeah, but wholesale rates haven't been for the last 6 months, and mortgage rates haven't been for the last 6 months. So we don't have a situation where interest rates are too low. We don't have a government spraying money around. So don't tell me there's a demand shock to the upside, because there's not. Elliott, you look like you're going to say something.
Yeah, well, that's exactly right. Kiwi households and Kiwi businesses have been doing it pretty tough over the past few months, but, you know, arguably over the past few years. And we're expecting, you know, rather than out of COVID for them to come out the gate wanting to spend more, do more, we're just expecting people to want to return to some version of normal. And that is unlikely to have a huge demand pressure in the economy.
That's right. So AI, definitely a subject matter that comes up in just about every presentation that I do. And I have a couple of one-liners that I use, but I don't have great insight, to be fair. What are your thoughts, Elliott?
Well, AI has a lot of potential to increase productivity. And as we all know, New Zealand's productivity levels have been a persistent structural issue over the past few decades. So I'm cautiously optimistic that investment in AI, both in the processes that New Zealand companies use, but also the development of AI tools in New Zealand itself, has the potential to make New Zealand a more productive economy. I'll certainly be keeping my ear to the wall in terms of how that plays out. But yeah, I remain cautiously optimistic.
Yeah, I think there is a lot of maybe skepticism starting to trickle into markets about whether or not this is a bubble, if it's close to bursting, because there has been so many billions and billions of dollars poured in. Yeah, exactly. Trillions of dollars poured into this technology that isn't yet particularly profitable, at least not for the companies investing. And so the question is, how long can markets keep? Well, you have to allocate funds from somewhere to pour them into this technology.
Yeah,
right?
There's crowding out going on. I think we've seen it in a few major markets actually this year, including the Treasury market. I think had a little pop higher with money being allocated elsewhere. I'm with you. I think cautious optimism about how it's going to increase the productivity of everything, just because of what AI can do. It's incredible. So cautious optimism there for sure. I agree. But there are trillions of dollars being thrown at this. 6 trillion this year, 10 trillion next year, and I think it's like 16 trillion in 2030. Like the numbers are just insane. Like that's an incredible amount of money that's been drawn from other areas going into this. But there will be winners and losers, and those winners will just reap the benefits, I think, because I think the changes that are coming through are incredible.
Yeah.
It will be interesting to see, considering the investment is concentrated in a relatively small number of very, very large companies going forward. Once those companies have more established AI products, the extent to which there could be some concern over pricing. And New Zealand, as a bit of a price taker in global markets, I think has reason to be potentially keeping an eye on that into the future.
Yes. And how do you tax it?
Yeah. Wow. Recently, I saw a headline, and granted, I didn't read the full article. I noted that Trump was again doing his scaremongering, his fear tactics.
Yeah.
He basically tweeted that if other economies start taxing big US corporates, especially these big conglomerates that are investing in AI and the tech companies, he's going to impose 100% tariffs on those economies that choose to tax American companies, which is outlandish.
But
on brand.
Yeah, on brand. Yeah, exactly.
But yeah, there are so many issues of taxation and trying to regulate AI if it's possible, and if not, what do we do with the consequences of that?
And history suggests that, regulation is well behind what's going on, right? It just fails to keep up. You've seen it in banking and all sorts of things, right? The regulators are sort of chasing the tail a bit and very late to the party. And sometimes they're heavy-handed. Like after the 2008 crisis, I think we went through an age of regulation where banks, I think they were too heavy-handed in the end. Like the sort of pendulum swung too far the other way. Anyway, we'll see how that goes in AI. It'll be an interesting spot to watch. You guys are clever enough that if you're training AI, you're not training it well enough to replace us, right? Like the three of us need to keep our jobs.
Absolutely.
Throw some dodgy data into it every now and then just to slow it down a bit.
Elliott and I were doing our weekly write-up together this week, and we did use AI to help us come up with more tennis puns because we were kind of coming up short. Wimbledon is starting today, and so we thought we'd do a write-up around some tennis quips.
Right.
It was pretty witty, actually.
I haven't seen it yet. I've just come straight in here. All right, now
we think you're going to really like it, Jarrod. And readers, be assured that all of the actual insights and analysis came straight from mine and Alexandra's brain and our research. Copilot was purely used as a pun generation machine.
Yeah, the pun generation machine. Very good. Well, I'm glad to see we're using the full extent of AI here in our analysis. I like it.
Excellent. Well,
thank you. That's another week. We conclude. We're done. I look forward to seeing you next week. If you want a really good read, we've put out our Outlook note. Please have a look. If not, we'll speak to you again next week. Cheers.
Thanks, everyone.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.